an honor and pleasure to share some thoughts on this presentation, which I hope you can see. The title is Have We Avoided the COVID Insolvency Wave? And I think this is a question that is on many people's minds, not least because if we think back to where we were in the height of the early stages of the initial shock, it was three crises rolled into one. It was above all a health emergency, but it also induced an economic sudden stop, and for a brief period there was also a very sharp financial sudden stop as well. And I think as we were experiencing those initial stages of the shock, I think our thinking was going back to the events of the Great Financial Crisis and the aftermath. And I think there was certainly some concern that once the dust settled, the initial liquidity phase would give way to the subsequent solvency phase, so that as the economic sudden stop left its mark on credit quality, that this would ultimately impact the banking sector. But what we saw was that those initial fears did not materialize, and let me just illustrate that with this chart from one of our bulletins, from one of the BIS bulletins earlier this year. And what I have here are three series: unemployment in red, bankruptcies in blue, and GDP growth in yellow. And here I've inverted the GDP growth series so that you see the yellow line going up as the crisis hit. Now, normally, as you can see, these three series move together pretty closely. So if you want to know something about eventual insolvencies and the impact on the corporate sector, you can keep track of unemployment and GDP growth, as an indicator of how things will turn out. But what we've seen since last year was that whereas the red line and the yellow line have moved together, the bankruptcy curve has actually gone in the other direction. So far from there being a wave of insolvencies, we have seen, in fact, the bankruptcies actually declining, even relative to the levels of 2019. And this has given rise to what we may call the bankruptcy gap, the divergence between the various rules of thumb that we have learned to put in place about insolvencies and the actual outturn. And another way of illustrating this, and let me perhaps break this out into its components, is to look at the microdata as well, and thereby also gain some clues on the reasons for why this bankruptcy gap opened up. This chart is from an earlier BIS bulletin, and the references at the bottom of the slide. And let me just spend a couple of minutes just to explain what this chart is showing, so that we can look at this together. The horizontal axis in that top panel is showing how profits have changed over a fixed interval of time. And we're comparing two episodes. One is the COVID-19 episode in red, and blue is the GFC episode. And in the COVID episode, what we're doing is taking the period between the end of 2019 to the end of Q3 2020. And then over that 9-month period, we're asking how much has the profits of firms in our sample, and it's a pretty large sample, changed over those 3 quarters. And then to express that cumulative profits over those 3 quarters as a percentage of total assets. So that's what's going on in the horizontal axis. And it's a pretty large sample in that what we do is we take roughly 40,000 firms, and it covers all the major sectors, and the sample covers all the G20 countries plus Spain. Now, on the vertical axis, what we're measuring is the change in debt over the same period, again scaled by the assets. So so that we can think about the measurement across the horizontal and the vertical axis being roughly comparable. So what we see is that in the COVID-19 episode, and what we do is we fit a smoothing line across the sample. It's using a version of a spline technique, and we're fitting a line through the center of gravity of the sample, and then asking for those firms whose profits have decreased or increased by a certain percentage relative to assets, what's happened to their debt levels? Again, expressed as a percentage of total assets. And what you see for the COVID-19 episode is that for the firms that have had negative profits over this period, there has been an increase in debt. In other words, for those people, for those firms who have made larger losses, we have seen a larger increase in debt, and we see that from the slope of the red line, which is increasing in steepness as we go to the the slope is negative there, compared to the episode in the GFC where we see that it's pretty flat, that the level of debt was pretty unchanged over the GFC period, and here we're measuring it from the end of September 2008, so just before Lehman, until the end of March 2009. So that's a 6-month period, and over those 6 months period, we see that the level of debt remained pretty unchanged, even though in terms of the outturns of the profit, it's roughly comparable. And we see that in that narrow bottom panel, where if we just plot the density of firms depending on the change in their profit levels, the density itself looks quite similar. So just to sum up, just to again orient you on this chart, we're comparing two episodes, COVID-19 episode and the GFC episode. Both were very large shocks to the profitability of firms, and the distribution of the negative shock to profits look roughly the same as a percentage of total assets. But the change in the debt levels has been very different this time, in that firms were able to take on more debt, even though they were suffering very steep declines in their profit. The picture is even more dramatic when we focus on the sectors that were particularly affected by the pandemic. And here we're just focusing on the recent episode, just the COVID-19 episode, and then comparing those sectors that were more exposed to the shock with those sectors that were less exposed to the shock. So the more exposed sectors here are given by the pink line, and the less exposed sectors by the green line. What were the more exposed sectors? It's things like airlines, hotels, restaurants, leisure, entertainment, textile, apparel, and luxury goods. Now, the significance of that of this chart is further underlined if we look at that dotted line. So what that dotted line shows, so that's the 45-degree line, which would be the case for a firm, which a firm would follow if for every euro of losses that you made, you more than made up in terms of new loans, so that in terms of your so any losses in profits were actually filled by debt, for example. And what we see is that for those sectors that were more affected by the pandemic, which is the pink, they actually lie above that 45-degree line. And as we get to the very, very low tail here, the slope of that pink line more or less is parallel to the dotted line, which says, beyond a certain level, your losses were made up euro by euro by an increase in the debt. And that's, again, different from the blue line. So what this chart shows is the impact of something that Jose Manuel mentioned in his speech, which is that in the initial stage of the pandemic, a very important policy response was the fiscal response, where not only was it supporting activity through direct transfers to households, firms are also being supported through credit guarantee schemes, through various lending schemes, funding for lending schemes, and other support measures where the cash flow decrease was made up, and in some cases more than made up, by the continued flow of credit. And this was especially so for those sectors most affected. And these are just the breakdowns in this slide of how the respective sectors fared in this episode. Now, the natural question that arises is, well, yes, this was the liquidity phase, and the textbook response during the liquidity phase of a crisis is that you supply credit so that households and firms can tide themselves over for the very extreme circumstances that they find themselves, and that once the liquidity phase then abates, then that's the stage where we have to sift the winners and losers, and then, if necessary, have the orderly resolution. And I think when we look at the provisioning of banks, I think that scenario was very much a part of the story that we can see in the way that banks were provisioning in the early phase of the shock. So what this chart shows, again drawing on some work that we've been doing at the BIS, is to look at a sample of 57 large internationally active banks, and 42 of them are under the IFRS accounting standards, and 15 following US GAAP, and then tracking quarter by quarter what their provisioning practices were. And we're showing it in terms of these box charts, where the box shows the interquartile range, and the whiskers showing the maximum and the minimum. And what we see is that in the first quarter, we do see a sharp increase in provisions, as I am showing with the cursor here. There seems to be a bigger impact on US GAAP banks, and that continues into the second quarter. But from the third quarter onwards, we see that there is a great deal more, if you like, the setting in of a greater sense of comfort, if you like, where the banks are feeling less need to provision in the very aggressive way that they were doing in the first two quarters. So that so that when we get to the fourth quarter of last year, for some of the US GAAP banks, you see that the whiskers fall below the horizontal axis, which is to say that for some of the US GAAP banks, they were actually reversing some of the provisioning, and they were booking those former provisions as profits. And that story has pretty much continued into this year. For the US GAAP banks, we see these negative provisions coming in, although the whiskers are, quite wide. Q1 of this year, I mean, this is a slightly distorted picture because of the Archegos episode. So you should sort of focus on the box plots, and that sense of, if you like, a sigh of relief, you can see in the provisioning practices. Now, round about Q2. So think back to April, May, June of last year. I think there was a sort of sense of, well, we have just been through the liquidity phase. Are we about to see the solvency phase of the crisis set in? And you can think of the provisioning here as a kind of anticipation, if you like, of that scenario. But we have not really seen that kick in thereafter. So as you know, just as we saw in that very first chart that I started with, we haven't seen that solvency phase, really kick in. And given this kind of evidence, and let me show you one more chart, and then we can try and sort of piece together the puzzle here. This is the cumulative change as a share of the gross loans of Tier 1 capital, both of the IFRS banks and of the US GAAP banks, and we've seen the banks add to their capital levels, quite robustly from the second half of last year. And you see also the reserves for loan losses here sort of tapering off. So how can we understand the current situation? So I think it's worth going back to some of our theoretical models just to get a sense of how we can make sense of what looks like, on the surface at least, a bit of a puzzle. Because on the one hand, we know that this was a very large shock to the economy. And normally, if we follow the rules of thumb for unemployment and GDP growth, we would have expected large numbers of insolvencies by now, but we haven't seen that. And we also see the banking sector doing pretty well. So if we go back to a Vasilchek model, so let's go back to our standard toolkit. And let's go back to a Vasilchek one-factor model. And as you know, the Vasilchek one-factor model is just a multi-loan version of a Merton model, where the standard normal random variable is driving the outcome, driving the asset realization, and therefore possible default. But it has this the structure where the random variable, the standard normal random variable here, Zi, has two components. So one is a common component that's driving, if you like, the aggregate, the average outcome. And there is an idiosyncratic component, Xi, which pertains to that particular credit. And the rho parameter here is giving you a sense of how much the individual loan realization depends on the aggregate factor and how much is being driven by the idiosyncratic factor. And the way that this is set up, if you square the weights, they add up to 1. And so, and both Y and Xi are standard normals. And so the variance, which is the sum of the squares of the parameters, of these coefficients, would be 1. So the standard deviation of Zi is 1, and therefore Zi is also a standard normal random variable. And what the Vasilchek model delivers is the flexibility to model both the tail risk as well as the center of gravity of the whole distribution itself. So when we think about the outcome distribution, imagine that the bank has many of these individual loans, each one of them driven by a particular standard normal random variable Zi. They are correlated because there is this common component Y, but the common component puts a limit on the degree to which you can diversify your loan portfolio. However, the shape of the outcome distribution depends very much on how closely these loan outcomes are correlated. Now, on the left-hand panel here, I'm just giving you the outcome distributions for a notional asset value of 1 of a bank. And the epsilon here is the PD. It's the probability of default for each individual loan. As the PD increases, of course, the tail risk goes up in this first degree stochastic dominance sense. What's interesting is that, of course, the rho is also important, because the rho gives the degree to which two loans are going to be correlated. Now, the extreme case is when rho is 0. If rho is 0, then everything is idiosyncratic, and we can perfectly diversify, and we know exactly what the aggregate outcome is, so that the aggregate distribution would just then be a spike. But typically, when rho is non-zero, we would have a non-degenerate distribution. And as we vary the correlation, it changes the shape in this way, as we see on the right-hand panel, where we have a mean preserving spread of the distribution. So we have these two parameters moving around. And we have names for this. So the expected loss is the mean of this distribution. So I'm now flipping the axes. I'm now looking at the losses rather than the asset realizations. And the mean of distribution gives the rationale for the provisioning that the bank does. So the provisions are meant to cover expected losses. What we need capital for is to cover the unexpected losses. And that depends very much on the shape of the distribution. So depending on your value at risk confidence level, we have to have sufficient capital to cover unexpected losses up to some probability. And the question is, how has the shape of the distribution changed in such a way that we can try and make sense of what we have seen? So is it possible that we can make sense of what we see through a combination of shifts in the expected losses as well as the unexpected losses? The fact that provisions are falling is indicative of the fact that expected losses have been falling. But the crucial question for capital and ultimately the resilience of the banking sector is what's been happening to the distribution of unexpected losses. So what's been happening to the shape of the distribution itself? And let me, in this context, introduce one final piece of BIS research, and this is something that we put out during the summer. There's a BIS bulletin which introduces a longer research paper that was published last year, which is trying to get at some reliable indicators of the shapes of the expected and the unexpected loss distributions through some kind of time series exercise, whereby we're trying to forecast what these shapes might look like based on evidence from past credit cycles. And I see that my time is getting short, so let me just give you a quick description of what these ingredients would be. So in short, if you want to get a sense of how the expected losses will evolve over the medium term, the best way of doing it is to track what we call the debt service ratio. So it's to look at the not only the interest charge, but also the amortization, and assuming that that there is a standardized maturity, just calculate that debt service ratio. And it turns out that tracking debt service ratio, the debt service ratio does a pretty good job of tracking the future realization of expected losses. And just to give you a sense of how this would work, the left-hand panel plots how the loan loss rate here in red correlates with the debt service ratio here in blue. And you see the debt service ratio leads the loan loss rate. But if we were to translate this by 8 quarters, we have that scatter chart on the right-hand side, which lines up pretty well. So much for the debt service ratio, and the debt service ratio is now currently very, very low. The interesting question is, how could we forecast unexpected losses? And here it's a much more challenging exercise because we need to think about the dispersion and the tail risk. And there's no perfect way of doing it, but in this particular paper, what the authors do is to look at the forecast errors and get a sense of the dispersion of that forecast errors as a substitute, as a kind of proxy for unexpected loss, as a proxy for the forecast of these unexpected losses. And it turns out a very good way of doing this is to just track the credit to GDP ratio, and in particular the credit to GDP gap, which is, of course, something that's very familiar within the Basel III framework. And just to give you a sense of how this would look, here are two plots that on the left-hand side just give you a sense of that squared estimation error, which was very, very high in the lead up to the GFC. And you can see that the squared estimation error has been going up recently. And here on the right-hand side, we're doing the same kind of plot where we translate one series by 8 quarters and just plot the scatter. And we have something which looks, I mean, it's much noisier, but there is definitely some relationship there. So based on this kind of evidence, what if we were to project forward? What would we see? Well, as far as the eye can see, expected losses are actually very low. And that's the red squares here. And that's very much reflected in current financial conditions, very low rates, very accommodative financial conditions, and that's very much reflected in these red squares. For the unexpected loss forecast, we have these blue whiskers, which are trending up, which means that our forecasts, based on past data, based on past experience, we would expect to see larger deviations from our point forecast, and that would be a kind of a proxy for larger unexpected losses in the credit distribution itself. So I think this does raise some very interesting questions for us to ponder, because the bankruptcy gap shows that we were far too pessimistic at the beginning of the crisis as to what the outcome, compared to the outcome that actually materialized. But the question is, are we focusing too much on the expected loss calculations and too little on the unexpected loss calculations? And I think it does. Highlight some of the uncertainties that we face going forward. Definitely expected losses appear to be contained. But I think given past experience, we know that these are the periods when, and we've seen how the debt levels have gone up, when greater vigilance on very large unexpected outcomes may be warranted. Greater focus on those unexpected outcomes would be warranted. And it does actually reinforce something that Jose Manuel said in his speech, which is the need for continued attention to capital levels. So Jacob, why don't I finish there?
Okay, so thank you very much. So interesting topic. I was going to say that this is a good segue also to our first session of the workshop, right? But I think we have maybe time for a few questions for you before we pause a bit. So if there's anybody who would like to ask a question, now's your chance to challenge Shin a little bit here, if you wish. I'm not seeing anything. Am I looking at that here? I have here's a question. Has the BIS looked at the policy support mix between grants and loans, how it varies across countries, and how it might influence debt overhang risks from a frugal McCann?
Yes, absolutely. So the answer is yes. There are a couple of BIS bulletins that have addressed this. And also, the Financial Stability Institute at the BIS has also put out a couple of papers on this precise issue. I think the important point to bear in mind is that fiscal support at the very beginning, many of it was actually in the form of direct transfers. So it was actually, they were actually fiscal outlays, budgetary fiscal outlays, as well as the guarantees. And to that extent, there is a continuum, if you like, between the household sector and the corporate sector, or the business sector more generally. And but having said that, what we do know is that debt levels have also gone up, which means that some of those loans remain on the balance sheet, and so some of it has been forgiven, and so they're more in the nature of a direct transfer, but some of it remains on the books. And I think one issue that many people were concerned about in the early stages was, what if the business model of some of these firms never really recover? I think that those fears were allayed with the vaccine and this prospect that we will get back to something like normal, but it doesn't detract from the fact that that the debt is still there. And even if the bankruptcy process is completely efficient, you would still have the debt there, so that it doesn't really, solve the issue of the insolvencies that that the banks would face. So I think there is still something of something of an explanation that has to be fully explored.
Thank you.
So in that spirit, I have a couple of questions. I will try to see if I can make them into a coherent one question. If I fail, then I apologize in advance. But I have a point being made by Mahmoud from the Bank of England, basically saying, look, provisions and no loss provisions are really also a reflection of the scenarios banks rely on, right? So there's a bit of a noise in the provisions. And banks used like a very sad scenario in the middle of the crisis. Since then, they've returned to a less sad scenario as the extreme one, which creates noise in the provisions. And then I have a follow-up to that, which is, okay, but is this really the time to release provisions? What's your view?
Yeah, I think the question on provisioning, I think, is very appropriate. The accounting standards have also changed in the meanwhile. I think the pandemic, if you like, was a kind of first real test of IFRS 9 and the new provisioning regime. There is a considerable degree of judgment that goes into the provisioning, and I think scenario analysis actually is a very important component of this. I think an interesting question that we will need to examine eventually is to what extent banks themselves were swayed by financial market conditions. So when financial market conditions are very turbulent, you have very tight credit conditions ruling in the economy more generally, financial markets more generally. That may give rise to scenarios that are more cautious and larger provisions. I think one thing that we saw was that as the stock market recovered very strongly in the third and fourth quarters of last year, that very much coincided with a sense of, perhaps the financial markets are telling us that we shouldn't be so worried. And that could be one factor in the greater degree of comfort that bank management had in releasing some of those provisions. And I think it's when we think about provisioning versus capital, I think what does come up from the way that I presented the material, hopefully that sort of came through, is that yes, provisioning is very much about expected losses, and expected loss forecasts do seem to indicate very low losses, even compared to the past experience, because financial conditions in general are very accommodative and rates are very low. On the other hand, these are times when the range of outcomes going forward are wider than ever. And so for any given credit loss for any given confidence level in a value at risk model, that would tend to lean towards having higher capital rather than lower. I think that's the kind of message that that seems to come through when we look at the analysis. If you take that scenario, if you take the VAR confidence level seriously, and we take at face value this idea that the forecast errors are much wider when the credit to GDP ratio is very large, then I think that would push you towards having maintaining higher capital. And yeah, I see that there are many more questions coming up. So let me just stop there.
Yes, you have so I guess we have a group of questions here which are a little bit about an old theme to the BIS, right? Pro-cyclicality and policy measures. So, is there a risk that because of this, the clear fiscal stimulus, that actually bankruptcy rates are maybe even too low for what they really ought to be? And then again, I have the question from Cyril here about the role of accounting and the IFRS 9 rules, right? Interacting together here. What is your take there?
Yeah, I think those are very important questions, and I guess we don't really have a full answer yet because we need to accumulate the lessons as we go along. It's a first test of the provisioning regime. I guess one way that we could approach unexpected losses from a different angle is through the stress tests, and I think and this is where you Jacob and the whole of the EBA have been contributing a huge amount. And I guess there it's really about what that scenario is, and there is a sense that perhaps we should think about a meta stress test where we need to stress test the stress test. Because when we think about the scenarios, we should have those scenarios relative to, if you like, where we find ourselves in and the kind of immediate, post-crisis experience. If we do find that the stress test results that we get do not line up with this idea of a greater tail risk, then I think there is a discrepancy between the kind of time series evidence and the stress testing evidence. And are we taking too much comfort in the stress test in that case? If we, take the time series evidence as a kind of more, if you like, neutral, way of, setting the hurdle. So perhaps this is, a moment for us to think about stress testing the stress tests. Can we think about that sort of meta stress test that might be able to get at this larger tail risk?